Good evening, folks. Welcome to tonight's webinar. My name is Jeff Hooper. I'm the Chief Operating Officer here at Ackerman Group. We've got quite a few logged in tonight, so I'm giving everybody just a couple of seconds to get logged into our webinar. But we appreciate you taking a little bit of time with us tonight. This is actually the last in our series called Selling My Veterinary Hospital. This has been going on now for a couple of months. We've had over 265 veterinarians attend this series with us. And tonight we're wrapping it up with kind of a state of the market. Should be a great session tonight. We're really glad that you joined us. Those of you that might have missed some of the webinars in our session, back in February, early February, we kicked it off with when is the right time to sell? And then a very highly attended webinar called What the Heck is EBITDA, right? We talk a lot about EBITDA. When you consider selling your practice, EBITDA is extremely important, understanding all the components of it. We had a great session there. Hiring the right advisors, whether or not you might want to try to do this on your own or get some help. We had a couple of great panelists there for that webinar. Also talked a little bit about some of the corporate buyers, what you should know there, and also what the sale process looks like. So all of these webinars are on our website. If you'd like to go back and view them again or share them with a colleague, please feel free to do that. And again, thanks for coming tonight. Just a little bit about these webinars. We like for them to be kind of interactive. So we encourage you to ask questions a couple of ways. You can, there's a little Q&A button on your screen that you might see. You can just type your question in there. The panelists, Gary and I, will see those as they come through, and we'll read them back to the group before we answer. You can also put a question in the chat function, or if you just want to send us a note, feel free and do that in the chat function. Or if you'd like to speak, just raise your hand. There's a little hand button there, and I'll see your hand go up and unmute you so that you can ask your question. So really encourage lots of interaction here. Even if you have questions about some of our former topics in this series, please bring them up tonight. The objective here is just to try to wrap out this the series here, answer any questions you might have, and then kind of give you a pretty good feel for what's going on in the marketplace today. Before we dive in, just want to give everybody a little just background on Ackerman Group and kind of our model for success. You know, we really are focused on selling veterinary practices to the corporate market, and our model is really built around three principles. Number one is just trying to find our clients the best fit. In other words, the best cultural fit. Finding a buyer that's going to fit culturally with your clients, with your associates and staff. That's probably one of the most important things, and maybe one of the most overlooked aspects of selling your practice. Finding the right fit, you know, a company that integrates with your computer systems, your lab systems, maybe uses the same vendors that you use, and practice the type of medicine that you're used to practicing. A lot of you have built your practices over many years, and you know, really want to see that legacy continue, and your clients come to you and enjoy doing business with you because of the way you practice medicine. So, you know, the cultural fit and fit for a buyer is probably one of the most important aspects. Secondly is terms. You know, it's not all about price. Price can mean certain things, but the terms have to fit your exit strategy. The purchase and sale agreement is extremely complicated and complex. It's a long document that needs to be reviewed professionally to make sure that the terms fit your needs in terms of selling your practice. In those terms, we can have all kinds of strategies that may affect your total return, like earnouts or contingencies on the sale. Contingencies on future production is typically one of the terms that's very consistent in our engagements. And a lot of practices that we sell today are not for cash. Very few of the practices that we sell are for cash. So there's usually a partnership agreement or some type of a joint venture private equity agreement that needs to be negotiated and understood by all sellers. Obviously, your employment agreements are important. What kind of benefits are you going to receive? Non-compete agreements, what does that mean when you're done practicing, when you finish out your employment agreement and are done? What sort of non-compete terms will you be subject to post sale? And then don't forget about the terms on your real estate. If you own your real estate, negotiating triple net leases and good solid terms is really going to improve the value of your real estate. So terms are extremely important. Lastly, we don't want to forget about price. Price is very important, probably one of the most first thing everyone thinks about when selling their practice. There's more to price than just the sort of asking price or offer price, which we call enterprise value, which is typically a multiple of your earnings. That's kind of the starting point. There's a lot of value that can be built into a practice sale today that can give you much higher total return than just the enterprise value. And as I mentioned earlier, that's part of what the joint ventures and some private equity investments can do for you, is really improve your total return in terms of price. So I mentioned the earnouts. There's notes that you can take back on the sale of your practice. You can own a joint venture. You can own a piece of your practice going forward. All of those really affect the total price. So that's the package. That's a model for success for the Ackerman Group. We've sold approaching $1 billion in practice sales. We'll have that done by this summer, most likely. 130 practices or so. We'll probably get to 150, 55 by June or July. So a lot of experience and success around this model. We think it works pretty good. So I said, tonight's topic is what to expect in today's market. It's the last one in our series. So I mentioned, my name is Jeff Hooper. I'm the Chief Operating Officer here. Just a little quick background on me. I've spent most of my career in financial services. I was actually an Edward Jones financial planner. I've known Dr. Ackerman for about 35 years. He and I knew each other back when I was a financial planner. And he was a veterinarian in the same town that I was working. We got to know each other quite well. I ran a financial services business for about 16 years. Sold that, got into a lot of consulting. Again, I've kind of stayed around financial services, did a lot of technology consulting in the financial services space. Branched out into some real estate consulting as well in terms of fundraising and that kind of thing, which kind of morphed into some historic and low-income tax credit consulting that I did on the real estate side. Gary and I, have done business over the years on those topics, and when you hear about some of his background, you'll see some of the synergies there. I joined Gary in January of 2019, and pretty good timing here. We've got a pretty robust market, lots of veterinarians that are looking to sell and transition, and lots of buyers in the marketplace trying to find the right. So we're sitting here on some double-digit company. We're seeing a lot of activity and growth over the last several years here. So great place to be. As I mentioned, tonight's kind of a market update. We're going to talk a little bit about some of the buyers in the marketplace. I'm going to give you some background on where the buyers come from and who they might be. Then I'm going to kind of turn it over to Gary for a little bit more detail in terms of what is actually happening in the marketplace today. We're going to give you some statistics on some of our practice sales and what we're seeing in the marketplace. But I kind of wanted to give you just a little background on I'm sure some of you may have heard this and may be very familiar with what's driving the market. The term private equity is thrown around quite a lot. And that really is just a source of capital. Gary will talk a little bit about the various sectors in a minute, but this is kind of an overview of what's happening in the veterinary market. First of all, I kind of want to make sure everybody understands who is behind the private equity money, right? Where does the money come from to invest in the veterinary space? And typically private equity firms raise money from a couple of different types of investors. They can raise money from individual investors. They're what's called accredited investors. They're have a certain net worth or a certain amount of annual income to be able to invest in a private equity firm. Or they're wealthy individuals, they're family offices. Some very wealthy families do have businesses that are set up just to invest in various businesses. So a lot of individuals, accredited investors, can put money into private equity. The bulk of their assets really come from institutional investors, and that can be anything from insurance companies to university endowments. Pension funds over the last 5 or 6 years have really come into the private equity market in a big way. So lots and lots of capital is chasing sort of the best verticals or the best investments in the marketplace, and private equity is what's driving it. This chart that you see on the screen here kind of shows the rise in private equity fundraising over the last handful of years, really going back to 2006. You can see the trend there, sort of falling off when we had the recession back in 2008, 2009. Nobody knew where to invest back then. It's kind of like trying to catch a falling knife. Nobody really wanted to invest. So capital declined dramatically in all markets, including the veterinary space, but picked up again right after the recession. Again, this chart is a little outdated, but in 2019, over $315 billion was poured into the veterinary space, not just in hospitals, but all sectors of the veterinary market. 2020 was off to a slow start, and then the pandemic hit, but I haven't seen the final number for 2020 raised, but it's probably pretty close all in to the almost $315 billion that was raised in 2019. So lots and lots of capital driving this demand for veterinary practices, and primarily fueled by private equity investors. Just a little sort of comparison here to some of the other healthcare services that went through a consolidation. I'm sure you might be familiar with some of these. The dental space, sort of outpatient surgical care, home health care, physical therapy. Those are all very similar consolidations. You can kind of see where those industries are, and again, this number is a little outdated. I think the veterinary service market consolidation is closer to probably a 14 or 15% number today, where you can say physical therapy has been a little bit longer. Really, what we've seen in most consolidation efforts across various verticals is that the corporate consolidation kind of tops out around 30 to 35%, sometimes a little higher. The veterinary consolidation was well ahead of the United States in Europe, and that industry kind of topped out around 40%, really, corporate ownership. So we think we've got a ways to go, and given the demand in the marketplace, we may get there a little quicker than we think, but there's still quite a bit of room for the corporate market to continue to own veterinary hospitals. And not only are there a lot of money coming in, there's a lot of platforms, right? So you can see the growth in platforms really from 2017 at 23 platforms, 23 companies that were out trying to buy veterinary hospitals, has more than doubled this year. 2021, we've seen some more private equity, more companies coming into the market. You're going to see some consolidation most likely in the next few years. You're going to see some of the smaller fish gobbling up other smaller fish who might be gobbled up by bigger fish. So there will be some consolidation as things start to tighten a little bit over the next few years. But again, it's a good place to be. Lots of activity, and that's a strong sort of number of platforms to be searching for hospitals in the market. And this is kind of another example of kind of where we think we're going. About there's 28,000 or so veterinary hospitals in the United States. 2025, probably a pretty good picture. I think with the acceleration we're having right now, it might be a little sooner than that to get to 20-21%. But we really have a pretty good opportunity here to test the market. And as you hear Gary speak tonight, I think you're going to see that there's probably a lot of reason for you to be visiting a potential practice sale just based on where valuations are today, and kind of where we think where they think they're going to go versus what kind of value that you might see in your practice. So that's a little bit about just kind of where all the money's coming from. I'm going to turn it over to Gary now to chat a little bit more about some of the details and what he's seeing in the marketplace. Gary?
Jeff, thanks very much, and appreciate everybody for being on this this webinar. Again, it's the last of our series. We've spent a lot of time on going over the all of the different facets of planning veterinary practice sales and your transaction. And it's been a lot of fun. We've had a lot of good questions and things. And Jeff talked a little bit about his background and our joint background. The key point here for me is that I'm a veterinarian and I'm a former practice owner. I've owned multiple practices, but the last 20 years since I sold my practices in 2001, basically have been doing multiple different types of advisory for veterinarians. So we've been brokering sales of the veterinary buildings. I did a ton of work on 1031 exchanges on veterinary practice buildings for 7 or 8 years. I did a lot of work on investment planning and tax planning for veterinarians that were exiting practice ownership, and it came from doing that work that we just really started working on a lot of the corporate sales, that there was a need for the investment planning and the tax planning on it, and that kind of led into helping work on facilitating the sale also. And so we've been involved in hundreds of different types of transactions, a couple $1 billion of tax deferred transactions, veterinary and non-veterinary, real estate, not real estate, on practices and things like that. The one thing I would tell you is this background for Jeff and I lends to the holistic approach that we take to working with people and doing the transactions. It's not all about just selling your practice. It is all about finding the right fit, the right partner, the right terms. Probably 90% of the transactions we do now or more have some type of retained interest in your practice, a joint venture interest or an interest in the private equity entity that owns the veterinary company. And so you're really doing not only a sale, but a partnership and an investment, and the tax pieces play into it. And so it's routine for us to be integrating with your CPA. I mean, I talk to these guys regularly, having a transactional attorney, but also maybe a trust and estates attorney, integrating with your financial planner, because all of this this is likely to be the biggest financial transaction that you might do in your life. And you really only have one chance to get it right. And so what we're talking to you about is what's going on in the market. And I think you'll see the market's gotten busier, it's gotten more complex, the transactions have gotten more complex, but you're going to see you're a beneficiary of it. And the key here is, having good advice to work your way through it, because there's a lot of people, there's anybody who's got a reasonable size practice out there now is going to have numerous people knocking on their doors. Anybody who wants to do a corporate transaction on their own can obviously just go and do it, because there's plenty of people that are going to be there for you. The question is, are you going to get decent advice? Are you going to get a customized transaction? Are you going to get the best terms and things that you can potentially get? So, with that, I just wanted to chat with you a little bit about what we're seeing on the market. Jeff was talking about private equity. Interestingly, if you look at this is 2021 data, and so this is most recent over the last 12 months, what we're seeing in deal activity across all kinds of different things. And anybody who knows oil and gas, you can see energy is on the far left. Where you want to be on this chart is you want to be higher and further to the right. And you can look and see where healthcare is. It's about as high as anything, and it's furthest to the right. So what's happening is the deal count is increasing and the deal value is increasing. And both of these are happening at the same time in the industry that we're in. 2021 was an interesting year. I mean, 2020 was an interesting year for almost everybody. This was one of those circumstances that we ended up with a year that ended up being about the same as 2019 as far as amount of deals. It started off really good, but then March, April, May hit last year, and the world, the financial world collapsed for a couple of months, and we saw private equity interest rates go from 6% to 13%. We saw deal volume effectively go to zero. We had a number of transactions that got terminated or extended, or the deals recut, or all kinds of things. And then about June or July last year, everybody kind of realized, like, hey, vets aren't doing quite that bad. The economy's, some parts of it are shut down, but vets are doing pretty well. And by August or September, the roller coaster had gone full cycle. You'd gone down in the trough, and by now, the end of the summer, you're back up at the peak. And the private equity groups that were the investors in veterinary medicine realized, this is, we've got 20 investments in our fund, and our veterinary investment is top 2 or 3 in the fund. These guys are doing fine. What we've seen actually is kind of a shift to a little bit more services and a little less inventory, which tends to be a little bit more profitable. And so most of our practices that we're seeing right now are up in the 10 to 20% range. And so what that has done is it's translated into kind of the green light again, and the foot on the gas pedal for people who are in this industry. And it's also, there's a couple of things that are occurring at the practice level that also similar things are occurring at the company level that we're seeing. And so, these confluence of events that we're going to describe in a little bit are not only happening to the practices, but they're happening to the companies. And so there's a trickle down effect from what's happening to the companies to you, the owners of the practices. The outlook for 2021 is really good. I mean, we're seeing our practices are doing significantly better now in 2021 than in 2020. In particular, when you look at the first 2 quarters of 2020 or the second quarter of 2020, anybody that's going to be doing a sale based upon the trailing 12 months, which is what you're going to be judged on if you go to do a sale, their numbers are going to be significantly better once you get March, April, May behind them. And so what we're seeing is the numbers for both the practices and the companies are increasing, from an EBITDA perspective, fairly significantly right now. Debt's still really cheap, so the companies are out there buying quite a bit of debt, and so they're able to get debt. The financing rates have come down back to basically where levels were at the start of last year, but the profits of the company they're buying and the growth of those profits are significantly higher. And of the different arenas that these private equity funds or family office funds or whatever can invest in, the veterinary companies are pretty attractive. Let's call it a lower risk and higher return area than many of the areas that they might have considered putting dollars or already have dollars invested that didn't quite do so well over the last 12 months. The other thing that we're seeing is a lot of tax potential tax changes out there. There's a lot of discussion from the government right now about potential changes in capital gains rates. Everybody on this call that's considering selling a practice needs to pay attention to that, because this is generally, it's basically, targeted as a wealth tax, but anybody who's got any material practice investment of any kind if they sell their practice, they're going to have over $1 million of income that year. And so you're looking at potentially a higher tax rate on that. So you really need to be paying attention.
Sorry about that. I think we're having a little technical difficulty here with Dr. Ackerman, so please be patient with us. Let me see if I can get him back online here. Hang on one second. Sorry about that, folks. Just hang in there for 1 minute. Just trying to get Gary back into the webinar. Be right with you. All right, folks, we're going to pivot. I guess I cannot reach Gary, so we're going to continue on without him. Hopefully you can hear me. We're having all kinds of technical difficulties here. So I'm going to pick up kind of where he left off, and maybe he'll log back in just a second here. But again, the point he's trying to make really around some of the things that's happening this year around taxes are really a driving force behind what's happening in the marketplace. There's lots of conversation about capital gains rates. There's conversation about capital gains rates doubling under the new administration. It's pretty unlikely that they would be retroactive to the year 2021, but it has happened once before. So it is possible, but for the most part, we really anticipate taxes, capital gains taxes in particular, staying around the 20% mark, which is where they are today, which is if you sold your practice, that's where you would be, your tax rate would be on your the majority of your sale, whatever you sold in 2021. So it's even, a lot of people are having some pause in terms of how much cash they take versus how much folks might roll into either the joint venture or some type of private equity investment. You've got to do pretty well in your investment to make up for sort of double taxation, or at least a double increase in the capital gains rate. So lots to come on that, and hopefully Gary gets back in here. He is unlike me, he loves taxes, and he dives pretty deep into the tax structure, and probably nobody better in this business with tax mitigation strategies. Anybody that you are in the middle of a sale or contemplating a sale, I would certainly have you reach out to Gary or look at our website. He's got quite a few white papers and articles in our website that have to do with deferring taxes. So lots of good strategies that could come into play and help you. As I mentioned, right along with that whole tax discussion is some of the joint ventures or private equity participation structures that we see a lot of. As I mentioned, some folks are considering taking more cash. Those that are investing in private equity are probably pushing it out 4 or 5 years before they would think about cashing. Maybe kind of get through some of the knee-jerk reaction that we're having here to take care of some pandemic expenses and other sort of administrative changes that are happening in our government. So the target practices, really, it's kind of all over the place. We're seeing extremely aggressive offers on practices that would not necessarily generate the kind of interest that last year that we're seeing today. Practices, 2-doctor practices with maybe 15 to 18% gross margin are generating some extremely high multiples today. back a year from now, and I'll show you a chart in a second here, about a year from now, a year prior to now, we were seeing those multiples probably in the 10 to maybe 11 times earning at the most. And today those practices are selling for 12, 13, sometimes even higher than that. So there's a lot of demand for, well, I would call sort of the middle of the road, not the large practice, maybe 2.5 million of gross, 2 to 3 doctor practices. The bigger practices continue to garner some really good multiples, but for the most part, we're seeing a pretty good tick up in all of the target practices that buyers are looking at. No sign of Gary, so I'm going to keep rolling here. Hang on one second. As Gary talked a little bit about sort of operational growth that we're seeing in the marketplace, you know, I'm sure all of you have kind of felt the sort of call it dead cat bounce, which we would call the pandemic increase that you saw after a little bit of a deer in the headlights in January, February, March of last year, to just extremely solid revenue growth through the year. I think if you look across the United States, you're probably going to see veterinary hospitals growing 7-8% on average, and we see hospitals, depending on where they're located, some are growing in 18 and 20% year over year from 19 to 20. So I think you'll continue to see that. You know, revenue is going to continue to grow for most hospitals. You know, the market dynamics are such that you know, the kennels are empty and everybody has a dog, so that's going to bode well for continued revenue growth. And also, the consolidation also will increase profitability across some of the hospitals that have already been purchased. With the economies of scale that they bring to an acquisition, typically they're able to take a hospital from, say, 15-16% gross margin and grow it to their 22 to 25, where they like to operate. So across the industry, you're going to see some continued growth in revenue and some significant EBITDA growth through 2021, we think. Hot recruitment of associates. I'm sure all of you can relate to this one. Continues to be challenging across the country, especially challenging in the Northeast as well as California. We don't talk to anybody that's having difficulty or not having difficulty recruiting. I think it's probably another reason a lot of folks are looking at corporates and consolidators. A lot of these organizations do have the tentacles into universities and pretty strong, robust recruitment teams. Oh, hang on one second. Text from Gary. Let's see if he's trying to get back in. Nope. He's not coming back in. He had a complete power outage at his house. So unless he gets in the car and comes to my house, we're not going to hear from him. So sorry about that, folks. You're stuck with me tonight. So we're going to slug along here and see if we can't answer any questions for you. And I'll finish out Gary's slides. There's one that I really want to show you here in a second. As I mentioned, the DVM recruitment is going to continue to be challenging, but a lot of corporate entities are really good at that. And you know, if you're looking to sell, if you're trying to find just that 1 or 2 more doctors to move your hospital to the next level, a lot of times doing a joint venture, selling part of your practice, bringing in a partner that can help you recruit is extremely rewarding and can kind of help you get to that next level. Salaries probably will increase a little bit as you see revenues increase, because those veterinarians obviously are going to be in demand. You know, we typically model associate veterinarians at about a 20% of production. All buyers are kind of look at that as kind of an average, and then practice managing doctors at about 21%, 22% if they're working alone or not without a partner. So that's kind of where production has salaries have sort of leveled off. But again, with improved margins, you're probably going to see those gross numbers increase a little bit. again, there's burnout, there's the COVID, what I said, the dead cat bounce, which I guess we shouldn't use that term in the vet industry, but that's kind of a financial term. There's a lot of folks that just are sort of burnt out after last year. So that adds to the fuel to the fire here in terms of those folks that are looking to sell, and the inventory is continuing to increase. And again, that's why the private equity firms are here and looking for practices. This is really an interesting point I want to show you here. If you can see this this chart we pulled together. I'm going to try my pointer again here. And these are Ackerman Group practice sales. So every dot on this chart, and this is just a 12-month chart here, going back trailing 12 months through basically through June, and I've kind of projected some closes out through June of this year. The hospitals that I'm projecting closed are all under letter of intent, but it's really interesting to take a look at kind of where those enterprise value, in other words, initial multiples are traveling, right? You can see, and again, there's no, as I mentioned earlier, smaller hospitals are going to be slightly lower multiples. Larger hospitals are typically going to be the higher ones. But this is just, there is no filtering here of hospital size. This is just strictly multiples. But you can see a pretty clear trend really over the last 12 months. So, hospitals that we would normally have seen trade in the sort of 10 times earnings mark a year ago are trading, a little around 12 or even a little bit 12 and a half. We are seeing some amazing multiples. We sold a hospital or closing on a hospital in the Southeast that traded at above 18 times earnings. It was more of a sort of a location play with 2 hospitals here, both trading in those kinds of multiples, but primarily driven by location. These hospitals that you're seeing here, these are all under letter of intent for us now. So I kind of have a pretty good feel for where those multiples are going to be going forward. I think a lot of people in the industry would think this is a much more vertical line than it is, but the trend line is pretty accurate, and we're definitely seeing an uptick. I would call it 2 points this year from a year ago, and that bodes well for anybody that's in the market right now, anybody that's under letter of intent. Some of this in our inventory here is driven a little bit by a group that we put together, and we do get a little bit of a premium for some of our groups, and that pushed some of those multiples, in the sort of 13 range. But this is kind of where we are right now. Sort of that 10, what used to sell for 10 is now selling for 12, and that's kind of what again, it's a seller's market, and those are things that you need to be thinking about and possibly taking advantage of if you're thinking about selling your practice. So again, as we mentioned, multiples are creeping up. More and more competition for the good hospitals. We just put under letter of intent. We had normally probably 5 here. We had 10 offers on the hospital. So those doctors were able to sort of field between almost everybody, all of the big players in the industry, and decide kind of which one was the best fit. And as I mentioned earlier, terms and the cultural fit became as big a factor there as price, because everybody has to be sort of at the same market value if they want to compete. There's really an interesting dynamic in the marketplace, because a lot of the companies that have been buying hospitals for the last several years are going through their own financial changes. They're recapping, meaning bringing on new investors, which may come in and buy their entire company, or they may buy a minority stake. All of that creates a liquidity event for anybody that owns shares in the parent company. We have a lot of veterinary owners that have sold their practices and invested in parent companies. There are ways that you can invest in the parent company today, and you get some pretty good visibility into when their exit might be. And some of them are very short. Some of them are less than 12 months. Some of them are 18 months. So there's a pretty good opportunity, and we have one of our groups that we just pulled together is taking advantage of that market dynamic. We have some individual hospitals that are taking advantage of that, where you get a nice return in a short period of time, and then you can roll that money into invest into the parent company, or you can maybe pull out some more cash from that. So it's a really interesting dynamic as those companies continue to ramp and continue to refinance in that private equity sector. Again, we talked about sort of the record amounts of private equity that's that has come into the market. Gary mentioned here in his presentation kind of a rush at the end of the year. I like to laugh with my team that we're about to get busy. We're about as busy as we can possibly be. Things are really active right now in our marketplace. But I tend to agree with Gary as folks start thinking about whether or not they should sell this year or next year. If they don't move quick enough, there's going to be a pretty big rush to get practices sold before calendar year ends here, 2021, and take advantage of the lower capital gains rate. I would encourage everybody to not wait. It's really tough to find qualified attorneys, to get buyers that are willing to close on a short-term basis, to get practices closed in 60 or 90 days, especially if the volume continues the way we think it might be. So if you are considering selling, I would get some advice or begin thinking about how you're going to test the market today. And as Gary mentioned here in his PowerPoint, plan early. We've got some excellent veterinary attorneys. If you're doing this, I would certainly recommend hiring a veterinary attorney, somebody that only engages in the veterinary market. There's a lot. This is very, very unique in terms of other types of business sales. So having somebody that knows the buyers and knows their tendencies with regard to legal structure is really going to pay for itself. And again, just keep in mind, everything will probably take longer because everything is pretty busy. Question just came in here. I'll try to answer this one. Can you set your sale in installments under $1 million over, say, 5 years to avoid the higher capital gains rate? Absolutely. Installment sales are one very common practice. Again, Gary is the absolute best at structuring tax deferred sales. We do have some, as I mentioned, some white papers on our website that cover tax deferred strategies, but installment sales is a big part of it. There's even something called a monetized installment sale today, which a lot of folks are taking advantage of. It's a little bit on the aggressive side. Some of you may not be willing to take that sort of risk, but there's ways to defer taxes for 30 years during a monetized installment sale. So if you have some interest in learning about that, there's a little too much to cover on tonight's webinar, but lots of strategies out there. And again, if you have any questions, I'll try my best to answer them here. And if I can't answer them, I'll certainly get Gary to follow up with you in the morning. We'll just get everybody's email here and get answers out to everybody. Couple things. We are going to do one more series here starting in May. This is kind of everything else you might need to know about your practice sale. The last series was about exactly how to do it, but there's quite a few things that we left out of that series. Some of the topics we're probably going to cover are roadblocks. We've got lots and lots of things that trip up practice sales, like sometimes landlords can be difficult if you're having difficulty assigning your lease to a new buyer. They can completely derail a practice sale. If your associates are not on board and not willing to sign employment agreements, that can derail a sale. So there's lots of things that you probably ought to know on top of some of the things we shared with you in our last session. As I mentioned, definitely get some advice, or get some use your resources. Our website, our knowledge base is chock full of resources that are free to you. Do as much research as you can on there in terms of the topics that you're maybe unfamiliar with. Our webinars are on there. Feel free to peruse those at your convenience, and ask questions. We're here to answer any questions that you might have. You can go to our website and ask questions. I'm going to send everybody a link right now to our evaluation send this out here. Hopefully everybody can see that, but that's a link to our no cost, no obligation evaluation. So the evaluation is probably a starting point for discussion if you are considering selling your practice. If you don't know what it's worth, if you have a buyer that's telling you what your practice is worth, you're probably going to be negotiating from a position of weakness. So if the buyer is telling you what your earnings are and what they're willing to pay, you really don't have any leg to stand on there to negotiate. Well, that may not be my net EBITDA number. How did you arrive at that? They have no motivation to give you to squeeze every ounce of earnings out of your practice before they tack a multiple on it. So that link I just sent you is the Ackerman Group's no cost, no obligation evaluation. And what we do is we take a look at your trailing 12 months financials. We look at your practice data, and then we're going to give you our best estimate of your earnings number, what we think it might be. And then we compare that to 5 practices very similar to yours that we have sold. Again, it's not a detailed valuation that you can take to a bank for financing. This is strictly just comparables to the market. In other words, your practice is worth what someone is willing to pay for it. And if we think we can get pretty accurate on your earnings picture, then we can give you a pretty good feel for what we think the market would pay for your practice. And that's just a starting point, as we mentioned. There's lots of negotiation that goes into your practice sale beyond just the enterprise value. Again, that should give you some confidence if you're able to dive in there once you have your EBITDA number and have been able to dive into the resource center and answer any questions that you might have there. You can also just text us or email us questions through the website. And as I mentioned, we're here to help. So I don't see any other questions for tonight. And again, I apologize for our technical snafu here. I hope Gary's okay, and it probably was a downed tree or something in his yard. So sorry about that for this evening, but please visit us on the website. And we're also now on LinkedIn and Facebook and YouTube. That's our new marketing director, Amy Shane, has put us on the map here on LinkedIn and Facebook and YouTube. So go to Facebook and like our page. I think that's a good thing. And connect with us on LinkedIn. We will look forward to seeing you on the next webinar. And thanks again for joining.